Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for October 26, 2020. Please see our disclaimer for important information. In the chart pat this week, we return to our COVID tracker. We can see that daily 7-day moving average new positives are continuing to climb higher. Again, as we've been reporting over the last several weeks, this has less to do with the back to school and all of that as it does generally an emergence of what we're going to call kind of a third wave, if you will, because we had obviously the bump at the beginning of the pandemic and then another bump here midsummer. And this is starting to show evidence of something that we're seeing actually globally, a clear second wave overseas and a clear uptick in what we're seeing here in the States. And this is a quick look at urban versus rural. And, as we've been talking about as well, some of the original outbreaks were really focused on large urban areas like New York City, Houston, so on and so forth. And as you can see in that pink line, we're really getting a bump in rural infections. So these are areas that were, perhaps somewhat insulated just because of their remoteness and geography, et cetera. But they're clearly contributing to positive case volume now. Here's information that we get from covidtracking.com by way of First Trust, and it shows you the case fatality rate. So again, separate the news from the noise. Clearly, while case volume is going up, not to belittle the fact that we do have fatalities, but the fatality rate is continuing to eke down even as we see those positive cases. Hospitalization rates are going up. That's something that we need to obviously pay close attention to. It bears watching that, we've seen this before. We saw it during the summer. There was certainly some increased anxiety over bed availability, capacity in hospitals and things like that. We're up to about 40,000 currently hospitalized as of this was about the third week of October. It's fairly current data, so obviously something we'll need to watch. Here's our high frequency data indicators provided to us on a weekly basis by First Trust, and I've been showing these over the last several weeks, showing that on balance over the last month, the data has actually been pretty positive. Even over the last week, say like TSA checkpoint data hasn't been all that impressive, but we actually did hit the million passenger mark, which we'll show you in the next slide. Restaurant activity is kind of stalled out. Hospitality is still, so there's some puts and takes on balance, maybe a little bit positive over the last month, and then more industrial type indicators with regard to rail car traffic and steel production have been mixed at best. We still are well below on a capital utilization standpoint, CAPU, we're still well below where we were at the beginning of the year. So there's a lot of capacity utilization that is well below trend. And on weekly retail sales, we're going to drill down on that a little bit more, getting into the meat of the program here today. And then continuing claims are continuing to drop, which is positive. We've seen a little bit of positive traction in initial jobless claims, where for the balance of September, those numbers really kind of stalled out. So anyway, on balance, some positives, some negatives. I don't think anything that we should be terribly unnerved about at this point. So here's the TSA checkpoint data that I mentioned in the prior slide. This is passengers going through TSA checkpoints across the country. And as you can see, just a week ago, we eclipsed 1 million travelers on a particular day, which is a bit of a milestone because obviously we haven't seen that in a while. And you can see kind of a general uptrend despite the fact that we've seen a rise in cases for coronavirus here lately. Here is our vaccine pipeline tracker published by the New York Times. As you can see, we have 33 vaccines in early phase 1 testing, and that's very early stage, involves animal testing, whatnot, not by any stretch wide scale human testing. But yeah, I would say that that's the very front end. And then on the back end, we have 6 therapies that have been approved for limited use by the FDA, including one we heard last week, which is remdesivir. And so in between that, you've got phase 2, which is kind of a limited scope trial, not broad-based, looking at placebo versus active and whatnot. And then you get to a phase 3 if you're successful in phase 2, and those are the really large scale tests, and we've got 11 of those now. Again, all of this is being constricted in terms of timeline beyond anything that we've ever done before. I mean, the development timeline has been shortened like we've never seen it before. And so the problem is you're going to see things come up. You're going to see issues, people developing certain side effects that could not have been anticipated until you get to that large scale testing. And then you're going to have to deal with that. And in some cases, we've seen some of these trials actually literally stopped on a dime while they study that type of data. And so we're going to have, continue, I'll call it fits and starts on this. It's encouraging to see so many therapies in the pipeline right now, but phase 3 clinical trials sometimes take, 2, 3, 4 years before they complete. And we're asking of the system to get this done in a matter of months. And it's very hard to I guess, assume that you're going to have all the data that you need in that time frame. And as a result, I think there's a fair amount of people, and we've shown some of this data before, that have said, hey, listen, when this drug is available, I'm not going to be taking it. They don't want to be the first one in line. And so, that in and of itself could help extend the timeline for us to get back to normal for this, for wide scale vaccines to be available and to be used to actually combat this virus. Now, as we've kind of alluded to in some other slides, and as we've been watching over the last several weeks, Europe and rest of the world, but notably Europe, is going through a second wave now. I think that's clear by any yardstick. Obviously, temperatures are getting colder. People are not outside as much as they have been, so they're inside where the disease is more easily transmittable. And so as a result, you're seeing cases go up, which has obviously implications for all sorts of international tangents, whether it's production rates internationally as businesses are closed or new restrictions are put in place. Obviously, mobility is going to go down. Economic indicators are going to go down. And obviously, there's going to be some carryover into the U.S. And as we just saw a few slides ago, I mean, the U.S. is clearly seeing an uptick in cases. Now, obviously, the election and other things are kind of taking front and center on our news flow right now. But after we get past the election, this is going to be a real issue that we're going to need to be wrestling with. I mean, there's a lot of speculation over curbs in travel, mandatory curbs in travel over the holidays where people typically get together. And, we're dealing with Thanksgiving and Christmas, which are 2 very big travel occasions for people. And I think it's going to weigh on the conscience, weigh on the psyche. Obviously, it's going to have some impact on consumer spending, even though we're seeing a surge in online spending. But there are clearly tangents for what we're seeing in this chart right here for the next several months. So this is a chart, and it's 2 charts actually. One from BCA, which is some perspective on when the general public feels like there's going to be a vaccine. And so, if you had asked this question, and this is a survey that's been re-administered, so you can see that kind of the history of it. But back in September, the preponderance of people, 70% thought that there would be a vaccine available by the first quarter of next year. Now that number's dropped down to 40, and that's been replaced by an increase in the preponderance of respondents that think that it's going to be sometime in the second or third quarter of next year. And obviously there's a lesser component of folks that feel like it's going to be later than that. But clearly, if you assume, and again, these are respondents; these are not clinical researchers, and if you assume that this is correct, then I think you have to assume that obviously we're going to be dealing with economic issues related to the pandemic until or perhaps over the next at least 6 months, extending well into 2021. Now on the right one is what I was referring to in the prior slide, and that was folks that are increasingly saying, listen, I don't want to be the first in line, I'm going to wait. And that number is 50% right now in this NBC News and Wall Street Journal poll. Some will be lining up immediately to take it because they're very motivated to want to get back to where we were before the pandemic. And then you've got some uncertainty that kind of sits behind that. But I think the fact that you've got half of the respondents of that poll that say that they're going to wait, I think is something that we should bear watch for, especially as it ties back to that chart on the left that shows you that more people feel like a widespread vaccine is not going to be available until at least the second quarter of next year, which puts us already into April, May, June timeframe, if not later than that. I've been very curious as to what the public thinks about all of this, because I've observed in my own daily routine, people I talk to and people I observe out in public, what their attitudes are. And obviously there's a lot of people that are frankly sick and tired of restrictions. They're sick and tired of wearing masks, kind of this growing discontent, which unfortunately has been very politicized in this election. And these two charts here are from Gallup polls that have been administered consistently over the last several months since this pandemic has persisted. And you can see on the left-hand side, these are the attitudes towards social distancing and avoiding public places and small groups. And you can see at the height of the pandemic in April, that number was extremely high. Actually, it was maybe a little bit sad to see that it wasn't higher than that. But as you can see here, you've really seen those numbers kind of trickle down, even as we had a little bit of a bump in June, late June, July was when we had kind of a surge in cases, and you can see where it kind of flatlined. But as we've kind of passed through that, and even as we're beginning to see this caseload, it will be very interesting to see when this data gets extended out to October, because it comes to us at a lag. But even in September versus July, you can see those numbers sliding down a little bit. So more people willing to go out in public places, more people willing to congregate in small groups, so on and so forth. And then here on the right, this is a survey of mask use, and it's just asking people, have you worn masks? And the good news is that number is trending in the low 90s. Again, you're going to have those folks, the well-publicized folks that are rejecting this altogether as some form of, hierarchical oppression from government or what have you. But anyway, just thought those were very interesting charts to kind of help paint the picture of what national attitudes are with regard to distancing and mask use. Now we'll jump into some of the economic charts and then get into some of the market-related charts. Now this is just a chart from Jefferies showing U.S. economic activity. And you can see that we've kind of flatlined a little bit. And this is through July, so perhaps not the most current data, but So now we get into some economic charts and some market related data. And so one thing I wanted to focus on is, this whole notion that I've been talking about in my market minutes, and we've had some charts on this as well, is, what is the risk here that we see a pullback in retail sales at a time where we really don't need it? Obviously we've been talking about the fact that we've got more coronavirus cases, and people are increasingly worried about the status of the economy as people are it gets colder and people are isolated indoors and things like that. But we know that consumers account for 65-70% of the economy. They're very important. Their spending has been very important, and we've had retail sales, as you can see in this chart, that have really from their trough have really accelerated. Now, why is that? And the devil is always in the details. And we know for a fact that there was a lot of stimulus money that was put out there. And as you will see, find that interestingly enough, a lot of those incremental unemployed folks were responsible for a large part of that surge in spending. They weren't exclusively responsible for it, but because there were several different inputs into why this retail sales number has really spiked. A lot of people are shopping from home. We know that Amazon sales relative to brick and mortar retailers like Kohl's and people like that, there's a huge delta between those two. And that delta only continues to widen, which has other ramifications regarding the longevity of brick and mortar retail anyway. But here, as we just look at it on its face, I mean, it's a positive number. It's over the our previous trend line, and so let's dig into that just a little bit. So this is breaking down, this is information from JP Morgan that kind of breaks down the difference between employed versus unemployed and what they're spending. And we know that the employed, which is in the kind of the gold or amber colored line, is inherently going to be above what the unemployed is. But as you can see, with the benefit of all of the stimulus payments, and in May, June, and July, that the unemployed was really responsible as they were sitting at home, ostensibly looking for employment. But we know that there are a lot of folks that were just sitting on their incremental stimulus checks and spending those and incremental unemployment benefits. But that number is trailing off now in a fairly meaningful way because all of those benefits have largely gone away, with the exception of perhaps a little incremental unemployment benefit that is half of what it was during the first few months of the pandemic. But what's interesting here is what happens to all those unemployed. We know that we still have millions and millions of Americans that are displaced right now. So more follow-on here. Again, just kind of thought-provoking on what could happen to spending as we look out onto the horizon. This is just a snapshot on the labor market, but in a different way that we read about in the headlines. Now, what we're looking for is on the left-hand side. What I want to focus on here is the folks that are exiting the labor force. So from the beginning of the year, we have right now about 7% of the workforce that was intact at the beginning of the year is kind of, we've seen a change in a 7% increase in the number of people that have exited the workforce. Obviously we've seen a lot of people that we saw a big drop in the unemployed or employed, and we've seen those numbers pick back up. But the more telling number is the number of folks that are just exiting the workforce altogether, which if you were to include in the unemployment figures, you would actually see the unemployment rates go up, meaningfully. I mean, they're understated by the fact that you have people that are no longer in the workforce. So it becomes a math problem. But on the right-hand side, this represents people that are looking for jobs. And as we got into October, what I found really profound was the fact that those numbers are rolling off. So we had a huge uptick after the trough, a leveling off, and then a little bit of a bump there in September, and then those numbers have just really fallen off. So what does this represent? These are job hunting searches in aggregate, and then it's measured on a trend line basis. And so it's well below forecast for October. And that coupled with what you see on the left is kind of a little disconcerting in terms of the ability for us to maintain momentum in the labor market. And we know that that's important for spending. Obviously, we know it's important for productivity. We know it's important from a political standpoint because these people that are not in the workforce are not being able to spend and have the means unless there is some kind of a stimulus program that's put in place. And that has become this huge political football that we're wrestling with on a day-to-day basis. And we frankly may not get another congressional stimulus program by the end of the year. Housing market continues to be fairly strong. So we've got two representations of this. The charts actually look very similar, but the one on the left is the National Association of Home Builders expected single family sales 6 months out. So as we sit here today, 6 months henceforth, that number looks very strong. And this is over a multiple year period. So you can see that we're really in rarefied air where we are in terms of their home builder sentiment. And then on the right hand side is basically their optimism survey, and it's obviously very high as well. So we have low interest rates, and we'll talk about that in a second, but we have had historically low interest rates, and that has really fueled a lot of opportunity for home builders and home buyers and even existing home sales. We've seen a lot of turnover. We've seen it really turn into a seller's market with relatively low inventory. So suffice it to say, optimism in real estate is pretty high right now. Now here's something that I think bears watching. Now I don't think that we're going to see a tremendous movement in interest rates. I don't think that inflation is going to take root anytime soon. We have just too fragile an economy. The 10-year Treasury yield has typically been used to benchmark the 30-year conforming fixed mortgage rate. And so we saw earlier this year where that kind of disconnected a little bit. But lately, we've seen a pickup in that 10-year Treasury yield. And I think some of it has to do with maybe normalizing to a slightly higher level of interest rates on the 10-year. Right now, we're about 85 basis points, and we were about 70 basis points earlier. So the question is, have we bottomed out? Don't know. Obviously, if we have a rise in cases and new restrictions put in place, and then we have to kind of shut down parts of the economy because of this, that, and the other, that would obviously have an adverse impact and probably drive more interest in treasuries, which would drive the prices up and the yields back down. But if you look over on the right-hand side, you can see that this latest uptick in the 10-year rate has transmitted into the 30-year fixed mortgage rate. And so, obviously the optimism that we saw in the prior chart was predicated on these low interest rates. And if you see an uptick in 30-year fixed mortgages, then that has an impact on housing affordability and people's interest in not only refinancing mortgages but also moving and getting new mortgages. So we'll have to watch this. I don't think that this is setting a really concrete trend of materially higher interest rates. I think we're seeing a little bit of ebb and flow and maybe a little bit of buyback, if you will, from having reached that 70 basis point level back earlier last month. I'll focus a little bit on dividend investing in the market, and something I've paid attention to. And we've seen dividend payers not necessarily perform as well as the broader market, and obviously not nearly as well as technology. And technology stocks, on by and large, don't pay as high a dividend, but you've got companies like Apple that are cash flow, um, substantially cash flow positive, that do pay payouts. But in particular areas, like in banks and in oil and gas, which are the two charts you see here, we've seen really pronounced drops in dividends being paid. And so when you take a step back and realize over the last 25 years that 40% of the market return has been driven by dividends, it really makes you think that if you're seeing large scale dividend declines, it's going to have an impact on the savers that are already struggling to generate much of a yield on their savings because of low interest rates. And so a lot of people have said, uh, the equity market has been kind of the last person standing, if you will, because there's no place else to go for quality yield. In fact, a lot of foreign markets, their own treasury markets are in negative yield territory right now. So anyway, I just show these two to highlight the fact that we've had some significant dividend declines in a couple of key areas of the market, and that you will have to watch this going into 2021, for the benefit of dividends, or the contribution of dividends rather, to total return for stocks. I thought I'd include this chart from Bloomberg on net equity market supply. And so, what this tells us, interesting, is that it's taking a trend line of new stock offerings minus buybacks. So this is like net supply in the market. So when a company gets acquired, its stock basically goes away. So it reduces the supply of equities available to purchase on the publicly traded market. And so we've seen a lot of decline, billions, hundreds of billions of dollars, over the last decade being taken out as companies have been acquired, so on and so forth. And just interestingly enough, here in the coronavirus, we've seen a lot of new IPO activity, and particularly large sized IPOs. So we've actually had a bit of a spike this year in the amount of net equity supply. Interesting. These are some kind of technical indicators, I'll call them. And I wouldn't expect all of you to understand all of this, but these are things that kind of tell you where the market is, and what it tells me as somebody who pays attention to this is that you've got that you have a lot of optimism in the market, and on the top end you've got NASDAQ 100, we call them mini contracts, and so these are speculative positions that are being put on the market based on where you feel it's going to go. And we've had a huge spike in these contracts, and that's a very bullish sign. Down below, you've got the put call ratio, and you have a tremendous amount of call writing going relative to puts, and this tells me that people are much more optimistic on stocks continuing to go up than they are pessimistic about the risk of stocks going down. And then conversely, you have on the right, you've got a short interest ratio, which is also very bullish in and of itself. That would typically spike if you had a lot of institutional investors that were very pessimistic on the market. You'd see short interest really spike, but that number being as low as it is actually quite bullish from a technical standpoint. Buyback authorizations are also down. We've talked about dividends going down. Buybacks are going down too. This is, all in the name of capital preservation. A lot of this is, not a lot of this, but to some degree, this is influenced by very traditionally cash flow rich industries, and yeah, I would put energy. And I put banks in this bailiwick too, where they would use excess cash flow to go buy their stock. Well, now because we've seen a decline in net trade, we've seen challenges overall in certain parts of the economy that these people are hoarding cash and they're bolstering their balance sheets. And what it's doing is it's manifesting in these types of numbers like buybacks, dividends, etc. We'll kind of finish up the chart pack here with some comments on small caps. And what you're looking at here is actually a trend line going back to essentially 1925, the pre-Great Depression era, and looking at small cap relative to large caps. And as you can see, there have been long periods where large caps outperform small caps, and large caps by and large have outperformed small caps for quite some time here in this most recent decade. Excuse me. And we're at an inflection point now, which is pretty interesting. We've kind of reduced our allocation of small caps as we've watched. In a pandemic, you tend to focus on companies with the highest quality, the best balance sheets, and the best financial wherewithal and access to capital. All those things are important when you're dealing with uncertain economic times. And so, you would expect in that type of an environment where small caps, which are less able to access capital, that generally don't have a strong balance sheet or cash flow situation, that they don't perform as well. But what's interesting here is we've seen that kind of turn around. And this is a little bit of a multi-year trend, but we've seen huge outperformance by large caps. But I think now is a time, perhaps, when if we have the visibility of looking out 2 to 3 years of recovery, a post-pandemic environment, so on and so forth, that is maybe a little bit more sustainable, even if it's at a lower overall growth rate, that could provide the feedstock for small caps to begin to act a little bit better. However, there are some caveats. We'll talk about this next. This chart right here is, or two charts rather, the one on the left is a relative valuation of on a price to book ratio of small caps relative to large caps. And we've seen that number continue to slide, and while more money flows have gone into large caps and less money flows have gone into small caps, that the valuation differential has really been pronounced. I mean, we haven't seen this kind of value differential since essentially the tech bubble, when you had companies with essentially no book value considerably outperform, and that was a completely different time. But oddly enough, we're back to those levels in this relative price to book ranking. So what does that tell us? That tells us that small caps are really, really cheap compared to large caps, and that should obviously make you perk up and take notice. Just as we are cognizant of international stocks being much cheaper than domestic stocks and emerging markets being even cheaper than that. Obviously, those types of valuation differentials need a catalyst to be realized, and those differentials to narrow. I guess I'm beginning to make this case, perhaps, that if we see this settling out and this post-pandemic environment that gives us some room to kind of recover and regain the lost or destroyed economy that we had earlier this year, that it could provide the backdrop for an attractive allocation into small caps. So that's something we're studying right now. Now, on the right-hand side, there's always a pro. There's always cons to every pro, and this would be one of the cons at this point, is that as we sit here today, and we know a lot of small business has been adversely affected, a lot of permanent closures, permanent job losses, blah 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 blah. And more of this clearly is being the brunt of which is being borne by smaller companies, and by definition, smaller cap companies. that you have a lot of these companies in the S&P 600 index, which is the small cap index, that have negative trailing earnings. And yeah, that is a phenomenon that has really kind of taken root over the last year and then just simply accelerated over the last 6 months or 2 quarters of reporting that that we've seen uh, a lot of coronavirus impact on. And so that will probably take a while for itself to work itself out. And but even though we have a large number of stocks in the small cap index that are that have negative earnings, now frankly would be a good time to want to take a look at it. I will conclude with this. I found this over the last week, and it's really interesting. This is the Defense Advanced Research Projects Agency, or what was called DARPA. In the late 60s, DARPA was charged with putting together basically an intranet, if you will, a private network. And this is a map of what that looked like in 1973, which I came across in the reading this week. It's pretty interesting. You can see all of those nodes on that network: USC, Stanford, uh, Case Western, Mellon, or Carnegie Mellon, Harvard. All these nodes on the network for these research universities that have these defense contracts. And it's just interesting that you could put it all on one piece of paper back in 1973, and to think that we've grown from this little chart here to something that is really is almost without life form, is pretty impressive. Well, that will do it for this week. Enjoyed having you along for the ride. You see our information there. Please feel free to reach out to me with any questions or comments you have. Would love to hear from you. Otherwise, have a safe week, have a great week, and we'll talk to you again soon. Take care.